Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I wanted to talk to you on this video about the classifications at a high level of companies. So we have growth companies, we have value companies and value investing, and then finally we have GARP, or growth at a reasonable price. So I wanted to give you an idea of what each of those means. So let's start with growth companies. So growth companies are expanding. They're hiring, they have more people working, their sales are increasing at an increasing rate, earnings, if any, and they may not be profitable, are growing, and they usually have a high price to earnings. So price to earnings, or PE ratio, for these companies may either be undefined, meaning that they have no profit/earnings at all, or they could be quite large, so 30 to several hundred. So here you are paying a lot for each dollar of profits. The PE ratio indicates how much in dollars are you paying for each dollar of profits. And so these companies tend to be quite expensive, but they're getting more expensive. And a lot of these companies trade on excitement, future expectations, and sentiment, and just people get excited about them. So the earnings might also be growing faster than the industry or the overall market. And profits, if any, are being reinvested into the company, so you hardly get any dividends in growth companies. The price has built-in expectations of higher future earnings, and as I said, they may not be profitable today. So this is where an interesting thing happens when interest rates increase, because a lot of analysts use something called a deferred cash flow model to value the expected future cash flows of that company and to get a fair market value for the company. And so as these companies may not be making any profit today, you have a lot of expected future profits, and as interest rates go up, these future profits, when you bring them into today's dollars, are valued less thanks to that increase in interest rates. And so the fair valuation of the stock falls, and therefore the high growth, high PE stocks sell off. And we've seen that happening here at the end of 2021 and beginning of 2022 as interest rates are expected to increase. The second type of company at a high level is value, and value investors are the ones who look for these. So these companies are generally cheap, so they would have a low PE, and the price to book ratio might even be less than 1, meaning that if the company stopped its business today, the value of its assets is more than what the stock is trading at. Also, another definition of value companies are those that pay dividends. They could be trading at less than their fair or intrinsic value, and the PE ratio might be in the teens or even in single digits. So they are cheap. Because the companies are profitable today and have dividends today, increases in interest rates generally don't affect them significantly, because you're not bringing far off profits into today's value. You are getting profits today and dividends today. And lastly, there is a happy middle ground to these two extremes, which is called GARP, or growth at a reasonable price. It combines the tenets of both growth investing and value investing to find individual stocks. GARP investors look for companies that are showing consistent earnings growth above broad market levels, while excluding companies that have very high valuations. So to summarize the video, we have growth companies whose prices can move a lot to the upside on sentiment and excitement. But if the sentiment fades after the company stays unprofitable for some time, you can have significant losses in the share price. Value companies don't have significant price movements, neither up nor down, and they may pay dividends, but they're also not going to double for you in a year. And then we have GARP, which is the compromise that a lot of investors are looking for. So if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.